You go to work, you pay your bills, and you save whatever cash is left over at the end of the month. You're playing by the rules. But mathematically, that exact strategy is guaranteeing you go broke. The number sitting in your bank account might look stable or even go up a little with interest. That is your nominal wealth. But those digits do not actually matter. What matters is your real wealth. How many groceries, gallons of gas, or months of rent those digits can actually buy in the physical world. This chart tracks a starting $100,000 bank balance over 10 years. Assuming a 3% inflation rate, the number stays exactly the same, but the actual purchasing power shrinks down to the equivalent of just $74,000. You didn't spend that $26,000. You didn't invest it poorly. It just evaporated. But wealth does not actually disappear. It just changes hands. So if your purchasing power is gone, who took it? This recurring loss of value acts like a ghost line item on your budget, a recurring cost that drains your labor without a formal tax bill or your explicit consent. To track this loss of value, governments rely on a metric called the Consumer Price Index, or CPI. It is officially presented as the definitive measure of your cost of living. The CPI tracks a specific basket of goods, averaging out the costs of items like transportation, food, and healthcare. But it leaves out massive chunks of your actual expenses. If you own a home, the actual asset price of your house and the interest you pay on your mortgage are completely excluded from this calculation. Corporations also mask rising costs directly on the shelf. Instead of raising the price of your coffee or laundry detergent, they simply shrink the package size. You pay the exact same amount of money, but you carry home fewer ounces. Because official metrics are disconnected from lived reality, the reported inflation rate rarely matches your actual grocery bill. Citizens are flying blind, relying on data that drastically underestimates the true speed of their wealth erosion. For decades, hyper-efficient shipping and offshore labor kept consumer prices low. Those global supply chains are now entering a period of intense fragmentation. Nations are now prioritizing national security over economic efficiency. Countries are fracturing into opposing blocs, hoarding critical resources and moving manufacturing bases closer to home, even if it costs significantly more to do so. You can see the immediate impact of this tension on global shipping. Military disruptions in critical waterways force commercial cargo ships to reroute thousands of miles out of their way, adding massive delays and heavy insurance premiums to everyday goods. Economists call this cost-push inflation. When the raw materials and the diesel required to ship them get more expensive, manufacturers do not absorb those losses. They push them straight to the retail shelf. Every time you pay a premium for a gallon of gas, a bag of flour, or a plane ticket, you are directly financing the friction of this new geopolitical Cold War. So if your savings are losing value and global supply chains are bleeding cash, who is actually profiting from this setup? To answer that, we have to look at the long-term debt cycle. National governments have accumulated tens of trillions of dollars in debt. It is mathematically impossible for them to pay it back through normal taxation. Defaulting on that debt would collapse the global economy, and aggressively raising income taxes is political suicide. Instead, central banks opt for the most expedient solution. They print more currency, diluting the value of the money already in circulation. This creates a brutal paradox, which you can see mapped out in this split-screen timeline. Over a 10-year period, we track a prudent saver on the left and a heavily leveraged debtor on the right. Because the fiat currency is losing its purchasing power, the saver's pile of cash actively shrinks in real value. But look what happens on the other side of the ledger. The institution holding a fixed-rate loan is actively rewarded. As inflation rises, the real burden of their debt decreases because they get to pay back their massive loans using tomorrow's cheaper, devalued dollars. This is the true underlying function of inflation. It is a mathematically engineered wealth transfer, legally siphoning purchasing power out of your savings account to bail out indebted governments and highly leveraged corporations. Recognizing this trap is the first step to surviving it. The historical era where you could simply earn an income and safely stash cash in a checking account is dead. To protect your wealth, you must transition it out of paper currency and anchor it in real appreciating assets. You need to hold things that central banks cannot print out of thin air. Historically, real estate and broad market equities act as natural shields against inflation. Property owners can raise rents to match rising costs, and successful companies simply pass their increased production expenses straight down to consumers, protecting their stock value. Physical gold functions as an independent store of value. It has a track record of holding purchasing power across centuries, outlasting the paper currencies of fallen empires. If you want government-backed stability, there are specialized instruments like Treasury Inflation-Protected Securities, or TIPS. These bonds are mathematically designed to increase your principal value exactly in step with the Consumer Price Index, securing your real return above inflation. The global wealth transfer is already underway. You now have a choice. You can remain a passive observer as your purchasing power evaporates, or you can take control, acquire hard assets, and protect what is rightfully yours.